How's everybody doing out there?
Good. Hope everybody can hear me.
Doing good.
Morning.
Morning.
Good morning.
Michelle's having surgery today, so I don't think she's not, I know she's not going to be on the meeting here, so I'm not sure if this is everybody here.
I think so.
Okay. So we should go ahead. This is our first Zoom meeting with the pension board, isn't it?
No, we had one in May.
Oh, okay. I forget. Okay, Michelle, are you ready?
Yes, I'm ready.
Okay. I call to order the General Employees Pension Board meeting of the City of Tarpon Springs, Florida. It's a virtual meeting on Thursday, September 17th, 2020 at 10 a.m. Could I please get the roll call?
Mr. Herring,
Here?
Ms. Niffen,
Present.
Commissioner Vaccaiotti?
Here,
Okay,
me, Michelle.
yes, okay. And Michelle Mims is absent, and Mr. Georgievic. I see him, so he is here present.
Okay.
Here, sorry about that.
That's okay.
Okay, our first item on the agenda is retirements, terminations, funds distributions report from the Human Resources Director.
Okay, the first on the list is Casey McConnell. Date of eligibility for funds distribution, July 2nd, 2020. Vesting schedule, 100%. The next is Alana Lance. Date of eligibility for funds distribution, July 24th, 2020. Vesting schedule, 100%. Lastly, we have Spencer Silver. Date of eligibility for funds distribution, August 10th, 2020. Vesting schedule, 100%. And that concludes my report for this quarter.
Okay, do I have a motion to approve the retirements terminations?
Motion to approve the retirements terminations as read by the Human Resource Director.
I'll second that motion.
Okay, all in favor?
Aye.
Aye.
Yeah. Aye.
Second item, number 2, is presentation and discussion of quarterly fiduciary investment report by Mr. Michael Montgomery, Montgomery Plan Investment Plan Advisors Incorporated, but Mike is not here, and we've got Mr. Ron Letaw here to present the report.
Well, thank you, Ron. And would you like me to share the report on the screen, or would you like to just follow along on the reports on your end?
I mean, it might be nice to see the report. I'm not sure what the rest of the board, if they
I
got
think
it.
sharing it would be good.
Yes, sharing
please.
it would be good. Thank you.
Perfect. I will do just that. I'm going to try to make this full screen so it is less of an eye chart on everyone's screen. Is everyone able to see it?
Yes.
Yeah.
Yes.
Yes.
Wonderful. Thank you so much. I'll turn my reminder off that we had this call. Apologize about that. Well, we have good news this quarter. All of the investments have continued to perform well. Obviously, second quarter was a lot better than first quarter in the markets and the economy. But we do, just as setting the stage, we did, at the request of the board, bring back an updated target date fund analysis review report. Last quarter, Mike presented an alternative to the current JP Morgan target date funds in the plan. There was a lower cost blend option that was available that had a little bit higher scores and lower costs. As we kind of highlighted, that's the current target date funds have a little higher cost. From my understanding and in Mike's recollection, the board asked to come back with some alternative target date fund management options, separate and distinct from JP Morgan. Just not sure that the intent was to strongly consider changing, but just to broaden the context by which you guys have the ability to review these. So we have that as well. So I'll probably move through the investment review at a little bit quicker pace than we do usually, just to make sure we have enough time to speak to the target date funds. Does that sound good?
Sounds good.
Yes.
All right. So I'll start out here with the executive summary on page 3. We'll start out with a quick market overview, as that seems to be kind of front and foremost in most people's minds this day and age with the volatility we have in the market. As I said, second quarter was a lot better than first quarter, where in first quarter we saw the market decline down 35%, moving from a bull market to a bear market. In a record setting, I'm just pulling my notes over 23 days, and March 23rd ended up to be, looking back now, the low point in the market. And after that low point in the market, we saw the market rebound back, and for Q2, we saw it bounce back by 44% from the bottom in 50 days. And the amount of days, the brevity and the amount of days was record setting, both on the downside. It lost 35% in a record setting 23 days. And it regained back 44% in a record setting 50 days. And since then, I have a stat I'm going to pull up here. It's not in your report, of just a little bit more looking back now. Again, we're here speaking to the quarter end to Q2, but if we look at the S&P 500's journey, it took 126 trading days, just 126 trading days to drop 35% and then come back up to a new record high. That trip usually takes about 6 years historically in the market. So it wasn't really necessarily the volume of how much the market dropped or how much it came back, because we know in 2008 and 2009 we saw a larger degree of retraction and a larger degree of expansion. But it's really the brevity of time, and I think it speaks to what we all probably expect, is that this is really an artificial economic and stock market pullback, as just resulting from COVID and the modifications of how we behave in our economy and how we work and how we meet on Zoom in this day and age. So the good news, though, is that a lot of analysts and stock and economists feel that the rebound of the stock market and some of the more positive economic factors that we've seen here, again, everything in this report is as of Q2, but since Q2, we've seen some promising economic factors. We've seen manufacturing increase for the last 4 months, which is promising. That's usually a leading indicator. If they're manufacturing product, that means that they're expecting to sell that product. And we've also seen the most recent ADP jobs report that in August, 1.3 million jobs were added to the economy, and unemployment applications were down. So, certainly the employment picture is still not rosy, but we're seeing some promising rebound effects there. And whereas we've heard all types of predictions on what type of economic recovery this is going to be, whether it be a V, where we drop and then we come back right off the bottom, whether it be a swoosh, as in the Nike kind of swoosh symbol on the logo, where it drops and then it's a slower kind of rebound, or whether we've heard W's, we're going to see it bounce and drop down and come back. But a lot of economists we're seeing now are kind of back on that V, or that swoosh shape recovery, which is promising to hear. Certainly the investment public and the investing community, as evidenced by, strong rebounds in the stock market. They have, which seems to be a forward-looking indicator of where people feel the economy is going to go. That's certainly there's a lot of promise out there with I mean, even the brief pullback we saw last week, you know, we saw the market then recover pretty quickly. So, you know, that's the state of the economy. We still have challenges. You know, we still have to navigate COVID. We'll see how the you know, when and where the vaccines come out and how that's adopted by the public, and you know, and what that leads to in terms of maybe lessening social distancing needs and so forth. You know, we are also in an election year, so, you know, there's an expectation that we probably are going to see volatility like we normally do in an election year, and we might not see a lot of this stabilize out until after the elections, as tends to normally to be the case in election cycles. You know, and we're still also waiting on, you know, there's been a tremendous amount of government stimulus and action by the Fed, but we're still waiting to see if we're going to get round two of governmental stimulus here before the election cycle. You know, and I know municipalities and local governments like yourself are waiting on that one, as that's the you know, the CARES Act 2, or whatever they're going to call it, tends to be the one that was going to fund and provide additional funding for local governments. But I've heard from other groups like yourselves that we have as clients that the tax revenues have increased slightly, and, you know, there's a better feeling as you guys kind of put forth your budget for next year of where those revenues are going to be for you for your budget cycle. I mean, how do you guys, you know, that's really wraps up my economic commentary, and I usually just like to kind of get an idea from you where the city feels the budget's going to be, how you guys are operating, how is it for your employees, how is it, you know, what's the expectation for the next, you know, 6, 12 months, et cetera.
You know, well, Ron, we've kept there's been no furloughs with the city. You know, we've kept everybody fully employed, paid. You know, with the revenues, we were budgeting a decline in, you know, in our sales tax revenues, roughly about 15% for the remaining 6 months of this current fiscal year and the 6 months of next fiscal year. You know, we saw our, you know, obviously things are closed down, our performing arts center, so there's no revenues coming in there. Recreation fees were, you know, that's basically saw a big drop because there's a lot of recreation programs. Golf course was shut down for a month and a half. So, you know, there's some revenue declines, and, you know, in the penny fund, also on the sales tax, you know, to the tune of maybe about, sales tax wise, maybe about $350,000 for us so far this year. But the last receipts in August, we did see a more of a positive sign on the sales tax receipts from August. So hopefully, maybe we budgeted for a decline in the revenues. Maybe I try to be positive, and, you know, I'm hoping maybe it won't be so bad, you know. But still, like, our performing arts center is still closed, and there's still a lot of recreation revenues that are we're not getting for the programs. The golf course reopened and had really, I think, some of its better summer months in the over the past 10, 15 years. I guess more people are going out golfing and stuff when it opened back up. In fact, it brought us back up to the revenues of the previous year by what they gained in June and July. So yeah, we budgeted for a decrease, but, you know, like you say, maybe you plan for the worst, maybe you hope for the best. So like I say, when we saw the uptick in the sales tax revenues in August, you know, that was sort of a little bright point there. So hopefully it continues. So that's my revenue for the city of Tarpon Springs and tying it to the budget.
Well, thank you. And I think that's anecdotally what we're hearing from a lot of our groups. No, it is promising. And I just know personally, I think I mentioned before that I was in a process earlier this year of selling our home up in Georgia. I'd been up in Atlanta area, and we relocated our family down here to Florida. And I'm now down in Manatee County with wife and 4 kids, and all 4 kids are, you know, they're back in school. 2 of them are full-time, 2 are still hybrid. middle school and high school. But I guess where I'm going with this is the county sports programs, like you said, the recreation, the youth football for my 8-year-olds opened up. I coach in that a little bit, and so I know that they still have yet to open the parks for the football games, but I know that's coming pretty quickly, and that'll drive their revenues as well for the renting of the space and so forth. So hopefully we see this continue to turn around and those things can happen. But I know every time I drive around town, I see a lot of people out golf. I guess, they're tired of being indoors and finding ways to get outside. So, well, good. Well, I appreciate that update. We're here hoping the best for y'all and all of our clients. So, any additional comments before I move into the investment monitoring section of the report?
No?
All right. Well, as I mentioned, the majority of your funds have continued to perform very well relative to their peers, according to our scorecard methodology. We rate funds 0 to 10. So any fund scoring a 7 or above is above average in terms of quality. Looking at risk-adjusted performance and style, purity, and expense structure. We do have 4 funds that are on the watch list. And all 4 of these funds were on the watch list last quarter. So there are new funds to the watch list. There's just the 4 that were on the watch list last quarter. The good news is 3 of the 4, the Templeton 4 and the Invesco Oppenheimer International Diversified and the Wells Fargo Core Bond, all improved scores. So they're now all receiving passing scores. Now they won't be removed from the watch list until they receive passing scores for 4 consecutive quarters. That allows them to come off probation. But 3 of the 4 are kind of turning that corner, and hopefully we see them improve. One fund, the American Fund's New Economy, it has now received a failing score for 2 consecutive quarters. It's received a score of a 5 this quarter, and this is the 2nd failing quarter. And it is, it's not consecutive, but it has dropped back down, and it has received a score of a 5. So now for 2 quarters. And so just to remind everyone, if we see a fund receive a failing score for 4 consecutive quarters, which isn't the case here because we haven't had these failing scores consecutive. If it receives a failing score for 4 consecutive quarters, we recommend replacement. If it receives a failing score that it's not consecutive, but if there's 5 of them in the preceding 8 quarters, then that would merit it being up for replacement. So nothing here that's needing or even close to immediate action on the watch list. I'll spend a little time. Any questions on that process? I know we have a few new folks on the board. Mike mentioned, so I just want to make sure I'm not fast forwarding through these criteria comments. Any questions before we can move and look at a little deeper dive on each one of these watch list funds?
No, I'm good.
I'm good.
Okay, very good. I'll be remiss if I skip this before we move on. We recommended a replacement of the JP Morgan U.S. Small Company Fund. The board looked at several options we presented and elected to move to the actively managed BlackRock Advantage Small Cap Core. That is scheduled to be completed. So that was approved by the board and submitted to ICMA and is scheduled to be completed on October 16th. Before I get to the watch list funds, I'll just kind of go through in the sequential order of the report. As of 6:30, we saw the plan assets rebound back from Q1. They're now just slightly over 20.6 million as of the end of Q2. The assets are a little higher now. I don't have the exact number as of yesterday's close of business, but we've certainly seen it further rebound. And I think Mike made the comment before that your plan, like others, we were pleasantly surprised to see not a large shift in assets, and sometimes we see, and it's usually in the retail investment public, people that are not in retirement plans, they tend to be a little bit more active when market situations change, and they might make changes in emotional response to the market, such as moving money into cash and out of the stock market. That hasn't been the case across the board with retirement plans, and your plan is not the exception. So we didn't see a huge shift to cash accounts or stability of principal. We saw most of the participants stay the course, which ended up being a great thing for them as we saw the market not quickly rebound back, and they didn't have to play the timing game of getting out too late and back in too late, which ends up being selling low and buying high, which is not what is optimal. So we didn't see a huge shift. I mean, any of the shifts we kind of would kind of speak to or rationalize away is mostly relative valuation. So if the stock market drops down and all of a sudden the value of that slice just got less, then it would look like everything else got bigger, but it was, again, it's a relative valuation thing just by, percentage and math. So, but anyway, not a lot of shifting, and the market has come back. So that's good news there. I'll move over here and we'll just jump into the watch list funds. So the American Funds New Economy, this is the one fund that we that dropped to a 5. So I'll just direct you down here. This is the historical score trends. We show the last 4 quarters. So this one in gray in bold is the score for the most recent quarter. It's a 5. But you can see the last 3 quarters, it was a 7. So this fund has kind of improved and dropped again, and I'll explain why. But the other score, and you won't see it on this page, but I looked it up before our time together today. It is 7 quarters ago. So that means in 2 quarters, that old score will fall off. And when we look back 8 quarters, we'll only see this 5, this one failing score, and maybe 2 other scores since then. So this fund kind of improved and for several quarters, 5 quarters, and then it's now dropped down to 5. So this fund is not really in any immediate cycle for replacement, if you will, unless we see continued underperformance for the future in the future. So I would almost, even though it says it has 2 failing quarters, it's probably going to be more realistic to kind of think mentally that it's got just 1, and we're going to be looking forward to seeing how it performs. Where it's lost its points is in one style category and the 3 risk return categories, if you can see my cursor, and then the return rate category. Now, first, let's talk about style. So this is a fund that's categorized currently as a large cap growth fund. So this is a U.S. stock fund that invests in large size companies using a growth approach. The reason it's losing this style drift point here is if you look down here, this chart shows pictorially where this fund's style and where it's been moving to and from. The higher and this is the fund, the red square. This is the category peer group, that black diamond, which is way up here in the top right. The higher the image is, the more invested it is in large size companies. The lower it is, the more it's investing in small size companies. The farther to the right is it's invested more in growth companies. The farther to the left, it's invested in value companies. So this fund is definitely in the growth category. It's definitely far right. So it's definitely investing in growth type of companies, which again, you don't want to overpay for a stock. The manager's looking for stocks that are of companies that are growing quicker or growing their earnings quicker than others in their peer group. And they don't want to overpay for the stock, but they'll pay for what they feel it's fairly valued, but they're looking for it to grow really quickly. So this fund's definitely using the growth approach. It's not losing its style drift point for what type of stocks it's investing in terms of growth or value. Where it's losing its point is because, as you can see, it's drifting down here to the mid or small size companies. And there's a number of reasons that could be happening. But American funds themselves, they don't ever say that they're going to stay in their prospectus, stay in large cap companies. They want to move. They want to be a growth approach here, but they want to move to wherever they feel the growth opportunities are. So this fund's starting to drift down to almost look more like a mid-sized company growth fund. And we'll just have to follow that and watch it. But I wouldn't be surprised if it was recategorized and before it might be merited for removal. And if that happens, then we'll talk about where to go from there. But most of the time we recommend replacing if a fund drifts to another category. You know, if we wanted to play first base and it starts cheating over and playing third base on us, we usually recommend getting rid of the third base, that person that's playing more like a third baseman, and getting a pure first baseman, if you can indulge me for my baseball analogy. But right now we're going to follow the process as we always do, as you always do, based upon our investment policy statement. But I think that fact that it's drifting down is feeding into why it's losing points in these other categories, because the leading performing category in the market has been large cap growth. So as it's moving away from large cap growth, it's moving away from where the performance has been. And when it's being compared to other first basemen, but it's starting to look more like a third baseman, and third base has not been the place to be the last quarter or two, and last, quarter or four really, then it's going to have a hard time competing against them. So we see, I'll just highlight this information ratio. This is a pretty deep negative. You want it to pass and get a point in this category, you have to have a positive number here. If this was a negative 0.09, that's pretty close to getting that point back. This is pretty deeply negative here at 0.99. This up-down capture, we want to see the larger number up top and a smaller number below. And the idea there is the top number represents on average historically how much of an advancing or appreciating stock market this fund has provided to investors. So you want to see if the market's been up 100%, you'd like to see it providing maybe 102, 103, some more value to investors on the upside. And then on the downside, we'd like to see that bottom number lower than 100, certainly lower than the top number, but lower than 100. And that's the downside protection. So in a declining market, how much of the market are people being exposed to? So here, the investors in this fund historically recently have been only receiving 87% of the upside of the market, and they've been exposed to 107% of the downside of the market. Those are pretty deeply upside down. And again, I think it's because we feel it's because the fund's kind of going in a different area and starting to look more like a third baseman instead of a first baseman. And then risk return, these numbers won't make sense without the context of the peer group risk number and the peer group return number. I can say this fund is returning much less than its peer group, and that's why it's failing that point. So we'll keep our eye on this fund. You can see we always look at performance kind of last, because in a vacuum without understanding risk and some of the other style components, it can be misleading. But when you look at the invest performance, it's underperformed both its index, the Russell 1000, as well as its category, the large cap growth, in this quarter, year to date, 1 year, and now, and you can see at 3 and 5, this fund's shown some more close performance to its peer group. But again, these performance, and you can see here in the second chart, I won't spend a lot of time here, but you can see year by year performance and where it had some really good years in 2017, in 2013, in 2015. That was a pretty strong year for it. But it's certainly lagging, and it's really because it's moving down, and it's really no fault of the fund manager, except that it's probably not a good decision by them, but they're following their prospectus. Their prospectus doesn't, again, make them invest just large cap growth. I'll pause. Are there any questions on this fund?
Ron, I just had a question there. You said as it moves to third base or something, but
Yeah.
I'm just if it performs well, but it's going into more of a mid cap growth, are we losing a an option in the large cap growth when you look at all the funds we have? Because we already have three mid to small cap growth companies on page. That's a page I'm looking at. I'm just thinking if
Yeah.
that one's moving down,
Yep.
do we, in it, maybe it's performing well, do we have to find a replacement in the large cap growth?
That's what you usually recommend, that if a fund shifts down, and a lot of our client menus, and it's certainly not the rule, but a lot of our client menus, we only recommend offering one fund in each one of these boxes.
Okay.
And that allows us to make sure we have one solid investment option in each category, so that when an investor, one of your employees meets with their representative from ICMA and they talk about how to invest their money and they need some in large cap, mid cap, small cap, they don't have a large menu of options to select from to try to, because now they say, okay, you need mid cap growth. Well, okay, which one? I've got three of them here. And that makes it a little bit, it's in some ways it's more options, which can be a good thing. But on the other hand, it can be more options can be a bad thing, because behavioral finance shows us that when investors have more to choose from, they tend to be more prone to indecisiveness and just putting the decision off. Think of us shopping, and grocery stores are the best at, they give us 3 options in something, and they don't want to give us 12 options, because if they give us 12, then we'll probably say, I got to go home, look it up and figure it out, talk to someone, and then I'll come back and buy it. Whereas if they have 2 options, they just kind of make a decision, whether it's price driven, they like the label. What is it? We do better with a smaller set. And so what we usually are recommending, and this is kind of, I think we gave you the option last quarter with JP Morgan, for example, is when a fund underperforms, and I know I'll get back to your style drift question. I know that's the heart of it, but I just thought I'd use this as a leverage opportunity. When we start seeing a fund kind of decline, when you've offered multiple options, sometimes we'll say, well, one option is just to get to remove that fund and just move the assets to the other existing fund. So you reduce down to one option in that menu, in that box. So it makes that an easier decision for employees going forward, and it reduces the number of options. And then what our job then is just to make sure we always have a solid option in every box. But we understand here that the discussion led to, there's a little nuance here. Do we want to eliminate the active manager here, because the Fidelity Small Cap is an index, right? Do we want to remove the JP Morgan, which is an actively managed mutual fund, and replace it with another actively managed mutual fund? Or do we just want to map it into the existing index and reduce the number of funds in that category? And the idea was there was still a preference to continue to offer an actively managed small cap blend. So there we made that decision. So with that nuanced example there, if we saw this new American Fund's new economy move down, it hasn't been officially recategorized by Morningstar yet, but if it does move down and recategorize to a mid-cap growth, we would usually recommend just using this opportunity to reduce the number of funds and map it into the existing large cap growth. However, we've got the same nuanced conversation we did over here. The Vanguard Growth is an index fund. So we would probably come back and give you 2 options like we did last time. Do we map it into the growth index that's already there, or do we replace it with another actively managed large cap growth fund? And I would probably lean towards recommending this category, add back another large cap growth actively managed fund.
Okay.
But so if it style drifts, we'll have that conversation with you immediately.
Okay.
If it stays here and it doesn't officially get recategorized, we would just follow the regular process.
Okay.
But if you would like us to next quarter, we'd be happy to come back with a few more pure large cap growth actively managed options, because you're certainly well within your board mandate, according to your investment policy statement, to make a decision like that just based on where this fund is starting to style drift. So a long-winded answer, you'll probably not want to ask me another one. What would you like to do? Would you like us to just follow it normally or come back with some options next quarter?
My preference would be that you come back with options. I see the tendency to the drift, and quite frankly, I'm not sure. I don't see it wobbling. I'm seeing it heading straight south. So I think options would be good.
I agree.
I agree.
Sounds
Also.
good, Ron. Thank you.
I've got my marching orders. We'll bring those next quarter. I'm just making a large note for myself.
Okay, thank you.
I'm sorry. All right. When Mike and I both join, I usually take notes while he talks, and he does vice versa. But I appreciate your patience there. All right. So the other funds, these will be less of a conversation because I think they're showing promise here. The Templeton Foreign Advisor. This is a international large cap value fund. You can see that it's kind of drifted around, but it's kind of making its way back up to a large size company value fund. So we're not worried about any style drift. You get they're receiving all their points there. We're seeing it continue to lose points in the up down capture. It's just slightly, that 95 is just slightly below the 96. We like seeing them tight. We'd love to see the top number a lot higher than in size than the bottom number, but this just shows us this is a more conservative fund. On the upside, it's not going to have obtain as much of the upside, but on the downside, it's going to protect on the downside as well. So we could see this get the point next quarter by flipping around just slightly because they're very close. And likewise, the information ratio, it's just barely getting this point. It's positive, but only a 0.01. So we could see it lose this point. But the strength of the statistics here are not, they're not really strong, nor are they very weak. So they're just kind of middling. Same thing with the return rank. It's just barely passing there. To receive a point of a 1 there, it's got to be over 50. If it's below 50, it loses the point. And the only other point that it's losing here is in the qualitative category. You usually have 2 points here. It's lost a point, and the T is the tenure of the manager. So it changed its investment fund manager a number of quarters ago. It receives one of those points back as a fund manager has been there 3.5 years, and then it receives the second one back a year and a half later. So we'll see. We expected to see this point regained here shortly, but overall, nothing really concerning here. Again, it's kind of just slightly above average, and we could see points being removed or added, and we'll just follow the watch list process here. Any questions on that?
No.
Okay. Moving
No
on
questions.
to Invesco Oppenheimer International Diversified. This fund was recategorized last quarter. It was previously categorized as an international equity fund, which allows it to have a lot more large, small size companies in it, allows it to have emerging market exposure in addition to developed market exposures. All this is international, of course. Last quarter, it was recategorized to international large cap growth. We kind of scratch our head on this, but we're not in charge of categorizations. We follow the process and we follow the categorizations that are done in the marketplace. But as you can see here, this fund is not really a large cap growth fund. We felt it was more appropriately categorized here in the international equity category, but it was recategorized. And you know, there's some nuanced explanation for that I get a little bit of, but nonetheless, we're in this category now, and ever since it got recategorized, that's where it's being compared again a little bit. We feel a little unfairly to first baseman when it's really been a third baseman all along. So but again, you see the score is bumped up. The performance in this fund has been has been fairly solid. If you look over rolling 5 years, information ratio is just slightly negative. Up down capture is just slightly underwater, and risk return, it's just losing that. Again, you don't have the context of the numbers for the peer group, but it's just losing it slightly here. So it has improved to a 7. We'll continue to watch it according to a watch list process. So another one that's more style related, but again, we think this one was imposed on this fund unfairly a little bit, but again, we follow the process. Any questions on this fund?
No.
No,
All right. And then our last fund is the Wells Fargo Core Bond Fund. This fund was hurt like all other actively managed bond funds unfairly in Q1. Well, I guess it's fair, but I'll explain what happened in Q1. While the bond market was up, the only part of the bond market that was up was U.S. Treasuries and the other U.S. government bonds. All corporate bonds, all high yield bonds, which is where most actively managed funds invest more heavily to generate more return for investors. All of those, all corporate bonds, all high yield bonds took it on the chin, for lack of a better technical term. They then rebounded very strongly in Q2. Now in Q1, there was only, I believe, 8% of actively managed bond funds beat the index. Only 8%. That means 92% of actively managed bond funds all underperformed. So what we saw in Q2 is the market turned, the corporate bonds, high yield bonds returns tremendously. They led the bond market in returns, and all of these active managed funds that dropped down because in the components they're compared to the index, they've regained those points. And if you look at the performance year to date, you can see it. This fund's doing very well, outperforming its peer group by 200 basis points, just under 200 basis points, outperforming the index. And for the quarter, it's well outperforming the index and in line with its peer group, just slightly below its peer group. So this fund, we think it was just a very slight Q1 impact on the score. Any questions on that fund?
no,
No.
All right. I said I was going to keep my comments more brief, and I don't know if I've succeeded in that endeavor, so we can get to the target date fund. So I'm just gonna, if you don't mind, I'll skip the scorecard numbers on all the rest of the funds. If you look down, everything really has strong scores with the exception of the watch list funds we've talked about. So I'll scroll here to our target date fund. Oh, and by the way, your stable value fund, the VT Vantage Point Plus fund, your cash account. We're really impressed with ICMA's managing of this fund. In this just really depressed interest rate environment, they're still showing a crediting rate, a net crediting rate of 2.25%. Right here, you can see it. This is the share, the R10 share is what you have in your plan, 2.225%. I wish I could find that rate for my personal savings outside of plans, but that's again doing very, very well. And the market to book ratio is strong. And the duration is, and they're not having to cheat out in duration to get that. I could explain that in more detail when we have more time, but we're very impressed with this fund. All right, I'm going to move quickly to the target date funds, and I'm sure Mike went through this in last quarter, and I believe I was scheduled to be attending your meeting, and something happened with my move where at last minute I had to change closing dates and move things around, and which didn't allow me to join. So I'm working off the notes Mike gave me, and he has a personal matter that came up unexpected. No worries, but he's out on leave. We expect him back next week. So I guess I didn't share that up front, but he provided me notes before he went out, and I believe he went through this target date tips for fiduciaries that was issued by the Department of Labor with you last quarter, or at least highlighted it. But I've included in the report here for your reference. Basically, the Department of Labor says for target date funds, we need to look at them a little differently than we do a large cap growth stock fund, because while every one of these target date fund families has a 2030 fund and a 2035 fund and a 2040 fund, that correlate with when someone's to retire. When you lift the hood on those funds, they can be dramatically different underneath. One can be really high risk, one can be very low risk, one can be moderate risk. So the Department of Labor in 2013, a few years after what we felt in 2009 with the global financial crisis, they realized how much variance there was in how these things performed in that downturn. And they said they came together and they issued this TIPS memo, which whenever the Department of Labor puts a TIPS memo out, we kind of adopted as kind of the new Bible for our industry in this regard, for just target date funds. And they basically put together a pretty user-friendly, sometimes the Department of Labor's guidance can be a little opaque and not user-friendly. They put together a really pretty user-friendly bullet point list. They say, first, establish a process for comparing and selecting target date funds. That's kind of what we're going to be talking about. We talked about last quarter and this quarter. Establish a process for periodic review. The nice thing about our scorecard system is our system applies a score, so we can provide quarterly updates on the scoring of these investment options versus only having to do it every 1 year or 2 years. Like I think that was the intent of the Department of Labor. So we're good there. Understand the fund's investment. So when you lift the hood on it, understand how much is invested in stocks and bonds. And how does that change over time? The glide path, which I know Mike explained to you last time, but we're going to look at it pictorially. Definitely keep an eye on the fees and expenses. You're never required to have the lowest expenses, but where you can, but you want to make sure you feel that the expenses are reasonable in light of what else is out there in the market. Again, you don't have to be lowest, but you just want to make sure that you keep an eye on those. And then always inquire whether a customer non-proprietary target date fund is available. Previously, when we were originally engaged with you all, you guys used ICMA's target date fund family, the Vantage Point target date funds, or most ICMA clients did. And when we're engaged with Fidelity clients, a lot of them use the Fidelity funds. Why? Because the record keeper that is also an investment manager has a preference to you using their proprietary investments so they can generate more economic benefit, some more revenue from their plan. So that's all that is. You're already checking that box because you already have a non-proprietary, you have a JP Morgan. And then you just want to make sure employee communications are handled. The record keepers, the ICMAs of the world do a very good job there. And then you want to make sure you're taking advantage of external resources like what we're putting in front of you. You don't want to just take the mutual fund company's word for it. If you looked at JP Morgan and went to look at all their materials, surprisingly enough, all their materials would say that their target date funds are great, right? And they might very well be great, and they do score well in our system. But you want to take an external third party approach and then document the process, which is what we're doing. So I'll first what I'll do is I'll fast forward here to this page. So last quarter we looked, this is the fund series you have now, the JP Morgan Smart Retirement. The average investment expense of the funds in the series, if you take them all, usually the farther away from retirement, the 2050s, 55, 60s, they're going to have higher expenses because they have more in stocks, which have higher expenses. And the closer you get to retirement, the expenses are going to be a little lower because they have more in bonds, which have lower expenses. But we just take an average of all of them. So the average expense ratio is 0.46. The glide path risk, I can't believe I don't have it in here. We don't have the glide path pictorial image. I apologize. I'm gonna speak to it in a different way, but the glide path is more moderate, and a glide path is when the glide path, think of it as like a plane landing. As you're farther away from retirement, the funds have more invested in stocks because a 20-year-old, a 30-year-old can afford to take the risk of having more stocks and generate potentially higher returns. But as you grow closer to retirement, this is with target date funds. This is with every personal investment. Ideally, an investor is revisiting every 3 to 5 years and reducing how much they have in stocks as they get closer to the time they need to retire, so that they're not exposed to too much stocks if the market turns south 2 to 3 years before they retire. So our system puts a risk category on that glide path. Where do they start? How do they de-risk over time, and where do they end up in retirement? So JP Morgan is a moderate. And then the style of the investments underneath, when you lift the hood, they're all actively managed mutual funds. And we talked about the JP Morgan blend, the way they were able to reduce their cost they're right over here from 46 down to about 29 as they added indexes in there in areas that they felt they could do so without taking away too much value in US large cap stocks, large cap international. Right, but the current funds you have are purely active funds underneath, actively managed. The JP Morgan have actively managed and passive. Then we look at the underlying score of the fund. So we lift the hood, not only how much stocks and bonds they have, but what investment funds are they using? Sometimes an investment manager, if they have a fund that's not performing well and not getting a lot of money invested from people, they'll hide it under their target date fund. And that's a way they can generate more money into that fund. So we always look at the underlying funds as well. And the underlying average score of the underlying funds is 7.9, which is strong in passing. And then the number of funds, they have 7 funds inside the fund. And when you lift the hood, it's invested in 7 underlying JP Morgan funds. So that's kind of the category. I won't speak much to this on the bottom line. So that's really where you are now. The JP Morgan Smart Retirement, they have the same glide path, so it's the same moderate. The expenses are lower, and that's because they add passive or index funds into the underlying investments. That forces they really replace some of the more lower scoring funds with the indexes, which makes the underlying score really strong at 9.1. And then there's only 2 funds that are on the watch list in the underlying funds. Now, that's what we looked at last quarter. So we were asked to bring back a couple more options. So what we did is we decided to bring back 2 pure index funds. I believe Wells Fargo was requested to the board. 2 pure index fund target date funds, BlackRock and Wells Fargo. Both of these are moderate, which is where we wanted to stay, because Mike said that the board felt more comfortable with a more moderately risk glide path. So we stayed in a moderate category. We brought 2 index funds back. BlackRock is the lowest cost index target date fund out there in the universe currently. It averages 0.09%, very, very low cost. And you can see the average underlying fund score is 9.8 because they use their own low cost index funds, their iShare index funds underneath, and they all score very well against the index. And they have no funds on watch list. So this is the lowest cost option. Wells Fargo, it is passive. Its cost is 0.14. The reason you see NAs here is when you lift the hood on it, it invests directly in stocks and bonds. It does not invest in underlying mutual funds. So there's no funds to score. We also brought in another blend just to show you another blend option. You've never heard of FIAM, but you've heard of Fidelity. This is Fidelity Investment Asset Management. They have a blended target date series. The fee is slightly less than JP Morgan's. It's a slightly more aggressive glide path, so it has a little bit more risk, and its underlying scores are 8. So we wanted to bring you a couple options back. I'm gonna talk a couple more points about each one, and then I'm gonna pause and let you guys ask questions, and then see where you'd like the discussion to go. While I don't have the glide path picture, I do have this, so you can see how the Fidelity is categorized as a little bit higher risk. First of all, the starting equity, so people that are farthest out, so your 2060 fund, your 2065 fund, these are for 20-year-olds, early 30s. They start out all around the same amount of equity exposure, with the exception of BlackRock. BlackRock starts out with only 1% invested in bonds. It's 99% in stock. Most of the others are around 90%. So it starts out aggressive. However, it starts to de-risk very early. When does it start rolling down? When does it start becoming more conservative? Here, it starts, you can see the BlackRock, the JP Morgan, and the Wells Fargo all start at age 35. So they start becoming more conservative early, and that's really what gets them into that moderate risk category. Fidelity waits until someone's 46 to start reducing their exposure to stocks. So they're invested in 90% in stocks until age 46. That's really the difference, and that's why they get primarily why they get the aggressive glide path categorization. And then where do they end? Well, Fidelity goes the deepest into retirement. They continue to de-risk all the way until someone's age 83. Whereas the JP Morgan, the BlackRock, both JP Morgan and BlackRock both get to their final resting place at age 65 and plateau out. And then Wells Fargo is right in the middle. They kind of go out to age 75. And then the last thing we look at is, we look at two more things. Where do they end up? So Fidelity, while it doesn't roll down till 46, it goes deep into retirement, and it ends up around 19% stock exposure. So it ends up getting the most conservative. BlackRock stops at 40%. Some people think that's some financial advisors say that's the minimum stock exposure you should have in retirement to beat inflation. Others would argue that's too high. You can see JP Morgan ends up at 33%, Wells Fargo ends up at 30%. And then at 65, when someone's retiring, this is sometimes the most eye-opening here. Fidelity is still at 51% exposure. Some would say that's, Fidelity would say that's appropriate based upon their asset allocation and regression modeling. Everyone has a reason. It ends up coming down to what you feel most comfortable with for your employees. JP Morgan at 65, it's all the way down to 33%. BlackRock's at 40, and then Wells Fargo's at 40. So Fidelity's the most aggressive. It ends up getting to the most conservative, and it's just because it starts rolling down later. All the others look very similar, and there's not too much nuance between their asset allocation strategy. It really comes down to if you're looking at the other four, it comes down to what do you feel about cost? What do you feel about active management versus passive versus a blend, and so forth. So our goal today, as Mike explained it and he recalled, was not to provide ultimate recommendations you guys walked into this meeting with the intent to change the target date fund family, but just to provide a little bit more perspective, open up the discussion a little further, and determine if you wanted to further this with, we wanted to get your ideas. If you wanted to further it, get your ideas on where preference you were leaning, so we could tighten up the options we bring if you were planning on moving. So I'll stop there and ask if y'all have any questions there.
I have a question just from kind of the new person on the board. What is our retirement age, typical or average retirement age for our employees these days? Do we know, or is it's still 65 or older or younger?
I am not sure. I don't know if we keep the statistic on that, or.
I don't think we do.
I think that might be insightful, if not useful, in kind of looking at these, especially with the roll down age and then the approximate equity exposure at 65. I know, you hear in the news that people are retiring a lot older these days. I don't know if that's true or not for the city of Tarpon Springs, but it might be useful information to get that data, or at least that data point.
You know, I know there's people that stay. I know in finance, you know, a few years ago, we had a couple people retire and they were both 71 years old, I believe.
Yeah, that's the other thing. I guess that's the age that you would normally retire at to maximize your Social Security benefits.
Right.
Yeah.
The other thing we could, look at is and these are questions. These are good questions, and I think this is what the Department of Labor was getting at when they said, "Here, understand what's under the hood and how that adjusts over time, and then consider what your employees are doing on average." To determine, for example, they talk about these funds here that stop at retirement age. These funds are generally for employees that don't expect to withdraw their 401k account savings immediately upon retirement, but would rather make periodic withdrawals over the span of the year. So just understanding what behaviors, that's the one that, a lot of people have latched onto because it was here in the Department of Labor tips. So when early, right around 2014, 2015 in our industry, there was a real big push to really dissecting underneath the plan. To your point, what are our participants doing? What are our employees doing? When are they retiring? What are they doing with their money? Are they leaving it in the plan or are they removing it? And what are their average deferral rates? Or in this case, what do they have a pension plan? Is this that's going to, and the idea is that with this money purchase pension, that this could, because you guys as an employer are contributing, they could take less risk here because they theoretically would have larger retirement balances because they'd be saving on their own in a 457 plan, et cetera. So there was a large push towards that. And what we found though, is there's we heard the same comments we heard here, a lot of anecdotal. I know someone, I hear someone, and everyone can remember a unique scenario. But when you started looking at averages in the plan, what's the average age people retire? What's the average deferral rate? A lot of the plans started looking very similar because there's really not an average employee. Everyone does their own thing. Some people leave the money in the plan. Some people retire late. Some people leave the employment of the city and move to another employment and take their money with them. So there's been, in our opinion, we tend to de-emphasize this with clients now. Let's not dig too much into statistics. I'm certainly not suggesting you not do that, but
Oops. Did
Guess
we
we
lose?
lost Ron.
I'm just saying to be beneficial for the group, especially given here you have a pension plan, you have something that you're making an employer. If we had a 401k client that just had a plan that was deferral only with no employer match, no employer contribution, they might, that looks a little different, and that might merit a higher risk glide path because participants need the better shot of generating higher returns. Whereas if a company has a pension plan, or you as an employer have a pension plan, maybe you can afford to have a lower risk glide path, which is kind of where you are now with a more moderate glide path. So I don't want to discourage us from deepening into that. Happy to talk to ICMA. They have a lot of stats on when people take distributions, and that might be a good average age to know, or, maybe in the last 3 years, what age were people taking distributions? I don't know if they'll necessarily have retirement dates unless you're feeding those to them. JD, I'll feed. Okay. So they'd probably be able to have some retirement dates in there to kind of run an average over the last 3 years. What date of birth were they when they terminated? We're certainly happy to help ask ICMA to do that for you and bring some of those numbers back. But I think what you're going to find is a little bit more of an average, But anyway, again, I don't want to discourage you all from doing it. I just want to provide some. I thought it was a great comment and exactly where we as an industry went in 2015. We kind of moved away from that, last few years.
And Ron, just so you know, we lost you for a few seconds there, but you came back.
Okay.
I just had on the slide you got up, you talk about under the hood. Is there something that as fiduciaries we need to provide, or are the employees getting their proxies and stuff so they know that what's under the hood of their target date funds they may choose?
Great question. They are legally being provided the prospectus information on ICMA, so you're fulfilling your fiduciary obligation to do that. What we find for most employees that are using target dates is they're using it because it's the easy button, right? It's the old Staples easy button.
Yep.
I don't know a lot about these investments. I know I should be diversified. I know I shouldn't put all my eggs in one basket. Is there something for me just to do easy? You know, back to my comment about less options tends to lead to more participation and more confidence by investors. They're picking these because they just want something that's going to take care of it. They tend not to be, the average participant using a target date fund tends to be not that interested in what's underneath. They just want to make sure what's under the hood is good. Now that's different for you as a fiduciary. As a fiduciary committee and a board, you want to know what's under the hood. And that's where we're doing this together because you want to feel comfortable. And this is what's under the hood for JP Morgan. So in the large cap categories, they have 5 funds. 4 of them are really good. One of them's been on watch list. In the small cap category, they have four small cap, mid cap funds. 2 of them are really good. 2 of them are watch list scores, international large cap. So this is what's underneath. These are all, with the exception of one, this iShares TIPS bond, all of these are actively managed funds. All of these are actively managed funds. If you look at the BlackRock, they have only one in each category. And this large cap, it's a Russell 1000. Small cap, mid caps covered by the Russell 2000. And these index, they just use broad indexes. They're not sacrificing coverage. They just use an index that covers everything rather than having a large cap international and emerging market international. They just have a total international stock. So they give participants inflation hedge with a real estate and a TIPS fund. Fidelity uses blend here again. They have some actively managed funds, this target date value, commingled pool. They have indexes. They have a small cap pool that's actively managed. This is an index, international that's actively managed. Commodities that's indexed. So they give inflation hedge with the commodities versus real estate or TIPS. And then they have a very diversified bond portfolio, whereas BlackRock had one total index. Here they break it out by segment. And then you look at JP Morgan Smart Retirement. They use the BlackRock indexes. BlackRock's indexes are labeled iShares. So they use the iShare indexes where they need to index, except for the Schwab, they use except for the real estate, they use Schwab. And then they have an actively managed US large cap. I'm sorry, I'm misspeaking. They have actively managed bonds, they have actively managed commodities, and they have an actively managed real estate. They do index large cap. And then other fixed income, they actively manage. So they feel that they were adding value in international, in bonds, and in sectors. That's how they lower their costs. And then, Wells Fargo, this is all index. They use their proprietary indexes and so forth. So that's the underlying exposure. And if you look at the scoring of these, the higher scoring ones here are the JP Morgan blend, the BlackRock, and the Fidelity blend. The JP Morgan target date that you have, it's being pulled down a little bit by the average score of the underlying funds and by the asset allocation score, how well it's performing relative to others, given the stock bond mix of its moderate glide path.
Ron, I'm just curious, the JP Morgan retirement, they got the word blend in there. Is that just, what does that mean? Or is that just because it's active and passive, or?
Bingo. And that's the fun. We've been talking to a lot of our clients that use the fully active JP Morgan funds about these blend funds, because it's a nice balance between the indexes. So you can save some money in the areas of indexing, where there might not be a lot of value added. And I'll just go back to that page here. So they have indexing in the US large cap, small cap, mid cap, and even international large cap, where they add their value and they're still actively managing is in the commodities, the real estate, core bonds, as well as specialized bonds in emerging markets. So emerging market debt. And because of that, it drops down to 0.29, and they're actually scoring out better there with the blends
In the actively.
than the actively. And you can save some costs there for employees. That's why we brought that. Then the conversation broadened. Well, let's see what else is out there. You can get blend less expensive. The Fidelity does, but it's a little bit more aggressive. So it's a little bit of and a slight orange and tangerine kind of thing. You can really reduce costs by going to a pure index like Wells Fargo or BlackRock, and BlackRock has some of the stronger scores.
Yeah.
And you still save moderate risk, but you get down to 0.09, but you'd sacrifice active management. And I think looking at our menu here in previous conversation with the board, there's a preference to having both index and active management. And that's what leads us to kind of blend strategies. And I'll say this, that where we see the market moving, a lot of mutual fund companies that have historically been only active managers like JP Morgan, only an actively managed target date fund, they are moving towards these blend approaches.
So when you use the term pure, that's a pure index fund versus the other ones where the other ones are actively managed ones.
Yes.
Okay. Yeah, when I first looked at it, I saw BlackRock. Boy, that looks good and stuff. Low cost, but then when you went to the fund selection, that sort of wasn't much there. But
And I don't want to. I think they just do it more efficiently here. What you don't get is you don't get some of the flavor of this. Does not have any foreign bonds. It has just U.S. So that's where it's lost some diversification element there. But it's really covering the whole U.S. bond market here. We have no concerns there. It does have nice inflation hedge with real estate and tips. We like seeing that. And then the other areas, the total international stock, it is getting your full international. It's getting developed, emerging market stocks. It's getting large caps, mid caps, small caps. So we feel it's really covering everything here. The only thing we see as a gap compared to some of the others is it doesn't have some global bond exposure. That's and then you see some groups that use commodities instead of real estate or tips as more of an inflation hedge for employees. But really, we don't see the BlackRock. I could tell you, I could go down the list. It's all public information with all of our governmental clients. But I will say that Hillsborough County just went through a very in-depth due diligence. And they've got their plan has $350 million in it, and it's a 457 plan. So you can imagine this, the size, and there was a significant portion of target dates. They went through a very detailed, in-depth process and ended up feeling very comfortable in selecting BlackRock. That's not to say BlackRock's the best choice for you, but they did go through that process. What we did with them, and we could certainly arrange for you all as well. We went through this process that they selected down to four finalists. And we held 15-minute interviews with each over the phone. So we met together in person, it was pre-COVID, but we had the fund companies dial in and do a 15-minute presentation each, 10 presentation, 5 Q&A. And they after that, the dust settled, they came back and decided upon BlackRock, like I said, but it was really close with a couple others. Other clients don't want to go through the interview process. Looking at this type of analysis and making a selection is just fine for them. But again, just throwing out different options for you guys to see what path you might feel like you might want to take.
How much money are we talking about for this potential change?
Great question. So right now, $9 million total are in the smart retirement target date funds.
That's a lot.
if I'm not mistaken, didn't I see that the whole program was $20 million?
Yeah,
So that's,
it's almost half.
yeah, it's a lot
And
of money.
that's indicative of a lot of plans because participants really enjoy the easy button. There's a lot of people, and generally it's somewhere in that 40 to 60% in target dates. 40 to 60% of participants want the easy button. They say, I can figure out how much I can save, or boy, I appreciate you guys contributing money into my retirement. I just want something that's diversified that I don't have to be involved with. Kind of consider them the ones that want to take their car to the oil change place, drop the keys and just say, please take care of it. But it's usually, again, 40 to 60% of the people in the population like to be involved, or they'd like to talk to someone like an ICMA representative and feel more involved with their mix. They want to change their own oil. So, but we are seeing more and more of a percentage of plan assets going into target date funds, which is why it's something we like to talk about, at least every 2 to 3 years to remind you what you're in and remind about other options out there.
So just taking it to the next step with these target date funds, and you going back to what we have right now, and BlackRock as an example, with the dates that you were showing on there, I think that the 65-year retirement target date and things like that, I'm not sure how that's supposed to work with employees within that fund and you mentioned earlier that they've got the target dates of 2030, 2040, 2050, that sort of thing. So within these funds, are there those target dates that you would pick one, or is this just one date? The fund presents one date.
And I apologize. That's a foundational educational component I probably should have covered early on. I didn't know how much Mike had covered or previous conversations. In every one of these target date series, they have when you select the series as a whole, and then all of those, they call them vintages, kind of think wine. All those vintage years are offered. And so you and usually they have a 65, a 2060, 2055, 2050, usually 5-year increments. All of these use 5-year increments. And they and when it makes sense to add a 2070 fund, because you have employees that are probably 18 years old that would retire in 2070, they'll add one of those. And those are usually automatically added to the menu at that time by the record keeper, in this case, ICMA. So you have those. And then you have the way they manage the near-term vintages differs by fund family. So remember I said, like Fidelity, they continue to manage down till 83. So they'll have a 2010 fund in their menu, and that'll be someone in retirement now, and it'll continue to exist until it gets down to that 83 age. And then they'll take that money and roll it into what they call their income fund or the retirement fund, the right. Ending slot. Now for BlackRock and JP Morgan and both JP Morgan funds, they end at 65. So last year they took their 2020 fund and they rolled it into the income fund because it reached its final resting part. So for JP Morgan, you'll never have a fund older than the current year you're in.
Okay. So basically what you show us, again, using BlackRock as an example, is basically their investment philosophy for all the target date funds within their series.
Yes.
Their glide path and everything. Okay.
And I apologize, I don't have the glide path. I'll follow up with an updated report after the meeting. Our system, when we generate this, has been a little glitchy, and it hasn't been putting that page in, even though it should be. But I will get that to you. And that's a pictorial reference. You can see they all kind of start off at the same height, and then you can see the everything except Fidelity starts dropping down in risk early, and then Fidelity stays high and then drops down, and then you can see where JP Morgan and BlackRock they end up at 65 and they flatline in retirement because they just get down to that. At age 65, they get down to their flat line, where Wells and BlackRock continue to kind of drop down. And every one of their funds is on that glide path. The 2065 fund is early. The 2040 fund was there 25 years ago. It's just farther down that glide path. So
Would-
everyone follows that same path. It's just dependent on where they are from their retirement age.
Would we expect to see the same performance of each of those target date funds within the series, or could some vary?
Everyone will vary. The ones that have
Yeah.
more stocks will
So
have,
I guess what I'm getting at is maybe within the series that you're showing us, you're giving us the broad stroke of the series. But I would think maybe equally important would be how each of those target date funds perform within that series. What we do now is, as far as our investment program, we want to maximize our investment return, but knowing that some of our investments aren't performing as well as others. And likewise, within these target date funds, the series, there could be individual funds that there may be some within the series, a larger proportion are not as performing as well as perhaps looking at the broad stroke as perhaps some of the others. Maybe I'm not, just from my experience, I don't have that experience to be able to have that insight. But I would assume that would be that is the potential case that we probably, before any decisions made, we should actually look at the target date, individual target dates within the series to see how they're doing. Or is that, you're expecting us to do that, I guess is what I'm getting, or maybe you don't do that.
no, we do that. We do that. And that's, so again, you select first, and again, I apologize, foundational element. I appreciate you asking a question. I'll back up and explain a little bit about how that's already taken into account with our scoring. Okay. Again, you can't use the Fidelity 2025 and take the Wells Fargo 2035, and you can't piecemeal these things together. So you adopt the whole series.
Right, I understand that. Yeah.
So we have to look at them as a whole, and there's always one or two that of the underlying vintages that when you compare it to others that are looking very similar, you kind of same glide path, because we kind of try to create custom peer groups to try to eliminate the noise of, whether one's riskier or the other and comparing apples to oranges. What we do is there's always going to be some that have a lower score, whether it's the quality of the underlying funds or whether that's the quality of the asset allocation, the stock bond mix. So what we've done here is that's why we look at averages for the series, because you want to have the series that are on average are passing. So when we let's look at the JP Morgan, the current ones you have. We have two scores here that then blend in to make the 7. This score is the allocation score. This is how well is JP Morgan managing the stock to bond mix in that glide path relative to others. And here it's receiving a score of a 6.9 in the asset allocation component, the stock bond mix. Then we look, well, what investment options is it offering to get to this, right? Let's not just the asset allocation mix, but let's look at the underlying score of the funds. There's 24 funds. We saw it. There was a lot in that one grid, this one right here, a lot of funds there, right? The average score of those is 7.9. Then we take an average of those two scores to get to the 7. So when you see a score that's a 7 or above, we've already done the due diligence. We're not going to let we're not going to put in front of you a target date family that is failing its score, whether it be asset allocation or whether it be the quality of the funds. What we like to, sometimes you can see a fund family that is getting, and Wells Fargo, again, is not getting our score because it doesn't have underlying funds that are scored. It just has the asset allocation score. And I could spend more time on that. And the asset allocation score is very poor here. We would probably steer you away from Wells Fargo. We just wanted to bring it because I think it was requested by the board to bring it. But if you look at BlackRock, its asset allocation scores decent, 7.5, 4. Where it's really overweighted is the quality of the underlying index funds are really high. The Fidelity is kind of a nice mix. It's got a very strong asset allocation score of over 8, and its average underlying fund score is an 8, so it's a really solid 8. So that we could look at them individually. What you'll quickly become is pretty frustrating because you'll say, gosh, there's some funds on watch list. Over here, the underlying funds, there's some funds on watch list I don't like, or over here in the allocation, you'll see some that, man, the 2045s and 2055, they're all scoring really well, but these ones in the middle are scoring low. And unfortunately, you have to kind of take the good with the bad with these target date fund series, and you're trying to get a better overall average.
Right.
But I do, so this scoring takes into account both the asset allocation and which takes into account the returns relative to peers. That is all incorporated on this score. I'll show you how this is done real quickly. So this is how we do target dates: the asset allocation score and the selection score. Selection score is easy. We just take all the funds, we average the score of all the underlying funds under the hood. The asset allocation is a little bit more in depth. To get to this score that gets 50%, we look at very similar to that kind of chart off for the other mutual funds. We look at style diversity, risk, style drift, style diversity, R squared, risk return factors. We look at all these up down captures for each individual vintage. The 2030, we do this score for the 2030, the 2035, 2040. All of this is done behind the scenes to then get to that average score over here.
Right, but
And I can show you all the detail. I could produce a report. It's going to be 100 pages long because the detail for each individual vintage and the underlying funds for each individual vintage, the 2020 fund, for example, it'd be there's a lot of pages. So for sake of easier consumption, we just kind of consolidate it to this one.
But what I was getting at is, would it be possible to show the standard deviation of the target date funds within the series?
Mm-hmm. Absolutely.
You've got the average, and I appreciate that, and I understand all of that. But what I was actually getting at was the actual, from a simple number would be the standard deviation.
Okay. And I'll show you, so for the JP Morgan target dates, we have the standard deviation is really, we don't use that statistic in our analysis, but it's really can be seen in the up down capture, because standard deviation is, I'm sure it's measure of risk. How if you see a fund here that's over 100, that would be a higher standard deviation, because on the upside or downside, because it would move. The risk would be higher relative to the market in all market conditions. These JP Morgans, because they all have 80s, that would be indicative of a lower standard deviation.
Right,
so I have it here. I can produce this for every one of these other alternative funds. If
no,
you'd like.
Not the table, Mr. Montgomery. What I'm saying is, if you take those 5 series, those 5 target funds within the series, and you would do a standard deviation, not what you're showing here, but on the previous slide for the fund itself, where you're showing the averages. Yes, those 2 that you talked about was the allocation and the selection. For example, you're showing the number of funds 6, and then the average score. Let's just use the BlackRock as an example. The number of funds 6 and the average score of 9.8. Within that 6 and that 9.8, in addition to the average, there would be a standard deviation number. In other words, that 9.8 would deviate, like, let's say 1.2 plus or minus 1.2 on either side. If you go down to the JP Morgan, the one just below that, Smart Retirement Plan, and you've got right there under the selection score, underlying funds of 9.1, that standard deviation might be 0.5 plus or minus 0.5, which to me would tell me that would be a little more, what would you call it? From a performance perspective, it would be a little more uniform within all the target date series. And I think that might be helpful for all the employees. So we could look at, let's say, BlackRock, but if they've got a fairly high standard deviation, that may not be as bad as going to JP Morgan, the one just below that at 9.1 with a tighter standard deviation. That might give a little more an opportunity for, as you said, you get the good and with the bad, but the bad isn't going to be that bad, and as compared to maybe something like BlackRock. So when you've got an employee that wants to push that button, but his particular fund isn't performing as well as the one that is the 10-year older or 20-year older, he may not choose that. And that's all I'm getting at. It's just a tool to help in the decision process at a later date.
Yeah, I can. I apologize. I did go the opposite way. I was thinking more in investment standard deviation, but you're saying standard deviation of the underlying qualitative or quantitative numbers. So, which yeah, how tight are they? How you know, it's the same thing with any average. Medians help, modes help. You know, I get it. Let me see what I can do. I know I could reproduce a report like this. So, for example. I'm just trying to find, okay, so here we go. So JP Morgan. So here you can see the allocation scores and the selection scores right next to each other. So we can quickly glance down, and I can do this for every one of these series. You have a low of a 7, I mean a low of a 5 here.
Yeah.
And it's their late term vintages because they're not as aggressively invested. They haven't responded as well in an up market. So you got lows, 5s and 6s here in the late term vintages, but in the near term vintages in the middle, it's a little stronger. So it goes from a 7, it goes from an 8 down to a 5.
Mm-hmm.
And then the underlying selection funds, they're all 7.9. So there's no standard deviation there at all. If I understand what you're asking for correctly.
Right,
so
right.
we know there's no standard deviation there. We know there's a standard deviation here, and the spread is 5, 6, 6, 7, and a few 8s.
Yeah.
And we can I can produce this report for all of those fund families.
Right. Let's take a quick look at BlackRock to see if there's any difference between that.
I didn't produce it for this.
Oh,
I'm
okay.
only able to show you
All
this
right,
because this is your
okay.
current one
All right.
in this
Yeah,
report. But I can create a new one for you.
No, that's okay. Just next time would be fine. I'm not, I don't want to create any more work than what our schedule is or what the plan is for progressing to this decision point. I just want to kind of have that opportunity to look at that number at some point in the future and kind of see, and if it doesn't say anything, then that's fine. I mean, if they're all the same, then that answers a question. That's not really a variable for us to be to even think about. But if there is some distinction between the ones we might be thinking about, we might want to take a harder look under the hood, I guess, as Ron says.
I think that's really a great observation and definitely something we should look at next quarter. And I can do that. Absolutely.
Yeah.
Really. And yeah, we'll see. I think you're going to see some that are more tight than JP Morgan. I think you'd see their blends are more tight.
Yeah, that'd be good.
Yep. And I think great point. Now, I'm making a note. I'll do that. And so where do y'all feel if it feels like we're going to continue the conversation next quarter? What do you like this mix of passive, fully indexed as well as the blends, the active passive, or do you want to see some more purely active? What would you like? Where do you think we go from here? And because there's probably a good 8 to 10 fund families we really like and that our clients are using that are, we like the JP Morgan retirement that you have now. We just think there's an opportunity to maybe improve upon that.
Yes.
So what do you feel we should change the mix of these, or should we bring the same ones back with just more detail?
I'm going to defer to the more experienced people on the board. I know Ms. Niffen does a lot of head nodding there, which is a good sign for me that someone knows what they're looking at. So maybe some of the others would help in that regard.
Yeah, and I think I'd probably like to see a little bit of each, and so we can see
Mhm.
what's out there. And I appreciate you putting all these together, but that was one of my questions, to see what else is out there besides the ones you brought back to us here. You know, if it's active, active and passive, maybe a little of each here.
I agree.
Okay. I'll add, oh, go ahead.
I agree also.
I agree.
And would you like me to look at some more aggressive ones too? Because I tried to stay away from aggressive.
Well, you've got one aggressive now, don't you, with the Fidelity?
I do. I pretty much, I'll just say I pretty much, this is pretty much all the high scoring, again, the scoring, like we talked about,
Yeah.
moderate ones out there.
Yeah.
But I could go reach out to some more aggressive. And again, they could be just slightly aggressive. I'll look at ones that are just slightly aggressive. And the way they kind of dictate that is when we look over here. I'm sorry. Let me find out where I am. The way they categorize active or I'm sorry, moderate or aggressive is over here on this risk index.
Hmm.
So you can see I stayed in the 50s, 60s at 80, and this is just slightly over it just barely gets into the aggressive category at 81. So I could look at some that are low 80s to bring you as well.
Yeah.
And I will make sure it has a glide path so you can kind of see that thing that I'm trying to explain on the screen. I really apologize that's not in this report. I'm disappointed it didn't get caught internally from our team. But I can go to slightly aggressive, and that'll allow me to add. There's several more index options out there available. Vanguard's, Fidelity, Freedom Index. And then we can also look at some other blends that are just not moderate right now that I wasn't able to show.
No, I think that'd be good.
That sounds good.
I'll
would agree.
try to keep it under 10 so we can pictorially see this on 2 pages without having, I tried to keep it to 5 because we can usually see everything on 1 page then, but I'll try to keep it under 10. And I don't think that's going to be overwhelmed because I think you'll be able to hone in, like you kind of honed in on if you're going to go index probably BlackRock from this subset, right? So I think we'll be able to still manage through this without feeling overwhelmed.
Yeah, Ron, in advance of the next meeting, is it possible to get what you put together ahead of time? So if we want to be able to look at it before the meeting?
I'd be happy to put it together after this meeting and send it, here within next week, just so you can have it. We'll still rerun it next quarter to incorporate the updated scores for Q3, but I don't mind putting together right now and just sending it as a follow-up to the group if you'd like.
I appreciate that if the board thinks the same way.
That's
Yes.
Sure.
I guess the one thing that concerns me, we got 9 million, but our current one, the target one, the JP Morgan, we're at 0.46. That expense, geez, employees could save money just by reducing that expense percentage there.
And I'll say though, if it makes you feel better, for actively managed funds, that is on the lower end for purely actively managed funds. There's others out there like a T. Rowe Price, which is a high quality fund, but they're in the 0.67s, 0.6 to 0.7% range. So 0.4 is reasonable for a fully active, but if you wanted to look at the kind of a blend approach or an index approach, you can drive it down quite a bit. But I agree with you, Ron. I agree with it. I just don't want you to feel don't feel bad about where you are.
Versus their blend one, which is a blend of their actively managed plus the index
Yes.
one.
And
Okay.
that's how they reduce it down to under 30 basis points.
Okay. That sounds good, Ron.
Well, thank you. And I apologize for misinterpreting your question there on standard deviation. And I appreciate
No.
your patience.
That's okay. I mean, I would probably not normally ask that, but there's a lot of information there, and I always look for ways to look at it a little more simpler.
And I love those ideas because I feed them up to the team that runs this, our CFA team that runs this behind the scenes. And I think that would be something that they might be able to incorporate here. And I think I think that's a great idea. They'll probably tell me it's going to cost too much to build into the programming, and I'll get my answer, but I like that idea. Well, I think that rounds out my discussion for my report. I know we're an hour and 39 minutes in, so I apologize for taking that length of time here, but I hope the discussion was helpful. I just direct everyone, we have all the performance numbers for all of the investment options in the back. We have a more in-depth market review in the back. And then we have that detailed explanation of how we arrive at all the scores based upon what type of fund it is, asset allocation, targeting, et cetera, in the back. So, but with that, I'll turn it back over.
No, I appreciate your thoroughness there, Ron, and your analogies there, third base, whatever, everything. You had some other ones there too, I like. But
I can give you sports analogies. I usually try to limit them though. I'm a baseball and a football coach, so I can go deep.
I want to make, are you Ron Laytall?
Yes, sir.
Okay, somewhere I got the name Montgomery. I know
Well,
that.
Mike Montgomery is usually,
All right, I got it. All right, I apologize for that.
it's right
No.
above his. It's right above his head there. It says Montgomery.
All right.
That's Mike. Our firm's named after Mike Montgomery
Okay.
of our firm.
Well, thanks, Ron. We'll go on to agenda item number 3, presentation and discussion of retirement plan investment advisory consulting agreement. And from what I understand, that Montgomery is merged with a different firm, my limited knowledge of it. And I'm sorry it was late, but we did get a letter because I was concerned about the previous firm, but we did get a letter from them. We sent it out to the board. Hopefully you got it, that the previous firm, it was terminated. And so there won't be any subsequent effects against the city here, but it was terminated as of June 30th. So from what I'm understanding, you're merging with a different firm, Ron, and I'll let you go on from there. And
Yeah, so for us to be able to provide investment advice legally under the SEC registration process, we have to be affiliated with what's called a registered investment advisor. I'm legally called an investment advisory representative. So I'm a representative of the registered investment advisor by which we're affiliated. We've historically over time, we tend to we have changed the registered investment advisor we're affiliated with. I think back when Mike started working with you, there was the RIA for short, registered investment advisor for short, was Financial Telesis for a number of reasons.
I remember that.
He looked at the marketplace had changed, and he elected to move to Independent Financial Partners. That's who we were with previously until June 30th. And that group was great. They had a really strong retirement plan focus. They had advisors that worked wealth management, but they had a lot of groups like ours that were our sole focus is to consult and advise employers like yourselves on their retirement plans, 401ks, 457s, 401s, 403bs, et cetera. So at the time they had strong support, and they become a little distracted. They created their own broker dealer. And that took a lot of distraction away, and a lot of firms like ours had started looking elsewhere. And so we kept our eyes open. We were pretty happy. We don't like to change for change's sake. Consider this like you might have a broker out there that's with Merrill Lynch, and then they move to Morgan Stanley or so forth. We don't like to change for change's sake, but we kept our eyes open, and a number of things happened. We saw a large trend in the marketplace to consolidate, groups like ours to consolidate with retirement RIAs that are very, very, very focused, hyper-focused on the employer retirement plan market. And again, that's all we do. So we're very interested in that. There was also a trend towards not only groups like ours affiliating with those groups, but actually merging with those groups. And Mike has been talking for a long time with us internally, our lead consultants, about a succession plan, contingency plans, just, prudent. He's not retiring anytime soon, but just that conversation. And we'd historically been thinking about an internal succession. However, as this whole trend in the marketplace continued to kind of take shape over the last 3 to 5 years, really heated up in the last 2, it made sense to listen to opportunities. When we thought about the opportunity of merging with a group, we wanted to make sure 2 things were going to be able to be done. One, that we were going to continue to be able to continue to provide the same services, reporting, everything that our clients have. We understand our clients have appreciated. We wanted to be able to continue to deliver that same structure. And we didn't want to be told that, hey, you're now part of us. You've got to do something different. We also wanted to be very careful that we were going to not be in a scenario where that new partner was going to force us to push any certain products on our clients, because we've always been independent, arm's length, completely agnostic with no conflicts of interest. And we listened to quite a few of these groups, and many of them, the red flags kind of went off pretty quick, and we just stopped the conversations. And I can name some names that you'd probably recognize, big names. And we said, thank you. We're honored to be, that there was a lot of groups that were really very interested. Mike's really done a very good job, has a strong reputation in the marketplace. But a lot of them we just stepped away from. This one, Resources is in turn owned by a large employee benefits group, One Digital. But Resources Investment Advisors, it started making a lot of sense. They wanted us to keep all of our staff. They wanted us to stay operating our own office. They wanted us to manage our own expense structure, continue to provide services to our employer clients the same way that we've always done. And they just really wanted to leverage our expertise and our influence in the market to expand their footprint. And they came and they bring tremendous scale and a very impressive investment back office that will have even more. We already have pretty much direct exposure to these fund managers from each of these funds, like the JP Morgan fund managers, the American funds fund manager, but they have weekly calls with these portfolio managers and gather a lot of insight and boil that down for us. So a lot of things just led us to go here now. So we're really excited, and we're excited that we're now part of this group. The only thing it might change down the line is you might see our brand change down the road sometime. Right now, they've said we want you to continue to operate under Montgomery Retirement Plan Advisors for the foreseeable future, because they don't really have a strong brand plan, which we like not having to be rushed down a process. We want it to be done thoughtfully and well structured. So that might be the only change you see, but everyone, Mike's got a 3-year contract with them at minimum. And all of our investment team, Steve McCormick, you've probably seen his name. He kind of supports me and Mike directly on our governmental business. He'll stay the same. So everything stays the same aside from maybe slight branding. But because we now are affiliated with this new registered investment advisor, Resources Investment Advisors, I'm now legally a representative of them. And your agreement is directly with the registered investment advisor. So the former one was with Independent Financial Partners. We need to modify that so Resources Investment Advisors is now the party to the agreement. And then, Mike and I will continue to be IARs, investment advisor representatives of them. There's really 2 ways to do this, Ron, and is it okay if I jump ahead to the 2 options?
Sure.
Yeah.
So there's 2 ways to do this. One is to execute a new agreement based upon the template of Resources Investment Advisors. They have a new advisory agreement that obligates us to be a fiduciary in the same way we're a fiduciary now, obligates us to very similar services as we do now to you. But it would be a new agreement similar to what you executed when we went from Financial Teleassist to Independent Financial Partners years ago. The other option, though, is perhaps an easier path forward. It's called a memorandum of assumption. It's a single-page document that basically says that Resources will assume the entirety of the agreement that was just recently terminated by IFP, Independent Financial Partners. They will assume that entire thing. Wherever IFP had an obligation to you as a registered investment advisor, they'd assume that without any modification. The one pager, so you don't have to feel the need to, you want to get that reviewed by whoever you have internally, legal counsel, procurement, but it wouldn't be renegotiating the full contract. So it's really whatever process you'd like. We have some governmental clients that prefer to draft a new agreement. Others that like the MOA, that memorandum of assumption, because it was just simpler to navigate through legal and procurement. So it's really up to you. We kind of apologize in advance for the paperwork, but we hope one of those options is very, one might work really well for you. And again, no services change, no personal and no fee changes. We're not proposing any change to the fee structure at all.
So Ron, our agreement, we are still working with Mike Montgomery and Ron Letaw and James Batmore. I'm not sure if I've met that person.
James is just the CIO, the Chief Investment Officers of Resources. They like to have him on there because he has even broader E&O exposure insurance than we ever had in the past. So by putting his name as part of the agreement, it just increases the E&O exposure that we have, that in turn you'd be beneficial of if there was ever any lawsuit brought against the plan.
Ron, one question I had is the memorandum of assumption versus just the whole contract you gave me. Is there anything different between the memorandum and it's the same contract where we're just assuming the previous contract versus what's in the one if we wanted to do with a full new contract?
Well, our legal counsel for Resources is asking us to get a new contract because they're always more comfortable with theirs than what they're assuming from others. But that said, they're very comfortable with the IFP agreement, and it really, I'm not a legal expert, but there might be something, an assignability clause. There might be something in there with this. I think the domicile of like if there was any dispute, where would the dispute occur? Obviously you'd modify that to be state of Florida in your city and county. If on their agreement, you've already done that with the IFP agreement. It's certainly easier just to go the memorandum of assumption because that you felt real comfortable with what you executed before with IFP. This way you don't have to go through the review. But there might be some slight changes. I'm not a legal expert to be able to speak to that. In terms of services and fees, what we do, while the wording's different, there would not be any change in practice of what we do.
So with the memorandum, it's got your Mike Montgomery, Ron Letaw's names on it. If we do the full contract, that's still the same. It still involves Mike Montgomery, Ron Letaw with that.
Yeah, I think right now in that one, they have one signature line. So either Mike or I would sign, but it would still be all of the full team. So it'd probably be Mike signing on behalf of the team.
I guess I'd like to see how the board feels. I guess, pardon me, I'm not sure, Jane, is this something we should send to the legal counsel or?
That was my thought. I think it would behoove us to send it to Adam Levinson, who is our Klausner, Kaufman and Levinson in Fort Lauderdale. They're our pension attorneys. I would feel more comfortable if they looked it over and were satisfied. They might recommend the one page, but I'd like to send them both documents so that they could have a look at it, maybe compare it and see exactly where the changes are between the IFP contract and this new one with Resources. I don't know how anybody else feels. I know we'll have to pay for it, but it might be well worth it.
I mean, from my perspective, I think that's an excellent idea. I don't think how a decision can be made without having legal counsel looking at it. But I've never really enjoyed memorandum of assumptions simply because of just those things that Mr. Letaw mentioned. There's going to be a loose end somewhere, or some misunderstanding or something like that. And I know the city is experiencing that right now with for example, the Mears extension. That was an assumption of a contract we had an agreement with an original developer, and that current developer simply assumed that contract, and now we've got some issues with them. So that we'll leave it up to, from my perspective, leave it up to the council, but my leaning would be toward a new contract altogether. And I was going to ask, as you mentioned, Mr. Lethal, this has happened in the past where you've changed, but it's always been Montgomery Retirement Advisors, right? It's always been yourselves as an agent for some other company. So this is a new animal that we're looking at in this.
It is slightly new. Yeah, technically, we've always, while we had a separate and distinct corporate structure, that Mike Montgomery was the sole owner of, it's never been anything except kind of a business where revenues flow through. We've always been kind of a DBA of our RA. When we hold ourselves out as advisor, we have to do it with an affiliation. So yeah. You'll go back and look that no agreement has been directly with us, the legal entity, Montgomery Retirement Plan Advisors, Inc. It's always been, you'll probably see our logo on there because it's really us, private labeling our individual firm that was distinctly owned by Mike, by Mr. Montgomery. But yeah, this is a little different in regards to we're now part of them. But really from a legal standpoint, in terms of reviewing the agreement that Mr. Levinson will see, he'll see no difference between how we structured the previous agreements till now. But for you guys, but absolutely as a bigger thing, Mike no longer owns the entirety of the firm. And that's the fundamental difference.
Were the memorandum agreements the last time that this was handled, or was it a different contract?
I wasn't here at the time, but I look back at the paperwork because we have a good paper trail. It was a new agreement.
What was that, Ms. Niffen? Yes, and a memoranda or an agreement?
New agreement.
It was a new agreement.
Okay.
In fact, I think it's the one that was one of the attachments. We had, was it Telesis Financial? Was that it, Ron?
Financial Telesis, and we went
Yes.
to Independent Financial Partners.
Correct. And we had a new agreement. So
Yeah. Okay.
One thing I was curious about, Ron, there's have we ever had a term limit?
Let me see. With you, I think we have with other groups, but I think with you all, it's always been without term. Again, the termination provision in our current agreement and in our new one will be, we serve at your pleasure because you can terminate our arrangement 30 days for whatever reason, without cause. So I think with you all, we've always had an open-ended term limit with you guys having the comfort that, you're never, there's no obligation. You can terminate any time.
You can terminate us too at any time, right?
We could. We could. I doubt we'd ever do it, but we could.
And the fee is just the 17,500 a year. That would maintain the same unless there's some. I noticed back in 2014 they amended the fees from the original contract, so it'd still be the 17,500 per year until that changes.
Yes, we certainly don't want to muddy the water with any of that conversation now.
Okay.
And we're very happy with the current fee structure. And at some point down the road, we might, due to cost of living, just, increases because our fee stays flat with no escalator. We might graciously ask for you to consider something like that. But certainly not this time. And we don't want to build any of that, any like automatic escalator into the agreement. Unless you'd like to, we'd be happy to take a raise, but no, we would not be proposing any of that now.
No, I'll stop there.
So in all seriousness, I mean, we understand the financial challenges of budgets these days. So we're not proactively having any of those conversations or intend to for the next few years.
Okay. Well, thanks for bringing that forward. We will send that off to Mr. Levinson, our legal counsel, and get back to you on that.
Is there a
Thank
time
you.
frame that we're looking at? I should ask a time frame for when we have to have something in place, or is that open-ended at this point?
Well, technically, your agreement with IFP, that their obligations ended June 30th. So what we're doing, we understand pragmatically, real world, there's always going to be a gap here because we really could not get in touch with you until it was formally announced. And forgive my dogs in the background. I'm still working from home. My two labs are excited. Amazon must have delivered something to the door.
It's our
We
revised contract.
I'm sorry.
You got it.
There's always going to be some gap. Our mode is we're still going to provide our services. We would just ask that the new agreement would be backdated to July 1, which is perfectly legal in the RA world, so that we, once it is executed, there's never been a break in service.
Right, because our last payment to you really goes to IFP through June 30th.
Yes.
So really, we're owing you the money for this third quarter from July 1st to September 30th. So,
And we won't, and that new payment would go to resources. It'd flow through resources, and we're not invoicing until we have an agreement.
okay. So hopefully
Because
maybe
legally I can't accept payment for something I'm not SEC registered to do.
okay.
We don't, I guess what I'm asking is, we don't need a special meeting on this, right? I mean, we meet quarterly, but we'll deal with this next quarter. Is that correct?
Well, unless we get it resolved or something, could we as a phone conversation, if we all agree with it, or send it out to everybody, or,
Ron, I think we have to meet in person.
okay,
What I'll do is today I will send it off to Adam, and he's usually pretty good about getting it back. And then at that point, we could schedule when I say this,
do a
we'll
Zoom?
schedule a short Zoom meeting.
okay.
And we can sign it and send it off to Mr. Montgomery and Company.
That sounds good.
Yeah, that's good.
And Jane, if Mr. Levinson needs to speak with someone about any of the terms of the new one, or even the MOA, it sounds like it's leaning towards a new agreement here. Our internal counsel, Phil Troyer, just let me know, and I can make him, I can connect him and
Okay.
Mr. Levinson, and they can have a phone conversation, and that's usually most efficient at getting on the same page. And that has happened with several of our clients where their counsel has wanted to speak with him, and everything's been a very positive, very quick response, as he's really open to what makes sense. And he drafts these agreements, so you're speaking directly to the drafter. So Mr. Levinson would be able, he'd be able to make the modifications right there on the spot and get him back an updated agreement.
Great.
Okay, good. Well, if that's it for item number 3 on the agenda, we got item number 4, other business. Anybody have any other business? Seeing none, we'll go to item 5, which is schedule the next board meeting. I guess we're looking at 3 months around the Christmas time or in middle December. Or Ron, I'm not sure if it's you and Mike, how the availability.
Yes, I am pulling up our calendars now, and I have Mike's calendar here. He made sure to make sure it was updated for this very reason. So I can say, first week of December. Do you all think you might be in a place to meet in person, or would it still be in a Zoom environment or TBD?
Probably Zoom.
It's probably Zoom. Who knows, but
I would
That
plan
always-
on-
I probably plan on Zoom.
I know I moved down here, guys, just to get closer so I can stop getting on airplanes and drive to client meetings, and then I'm stuck behind my desk with my dogs. We are very open the first 3 weeks of December. I mean, there's a couple of days. So if you throw out dates, like we're out 9th and 10th of December. And then have just some meetings scattered throughout the other parts of the week. But those 9th and 10th would probably be the ones.
How's the Thursday? Does that work good for everybody? The 10th of December?
I'm sorry, Ron, that's the one I can't do. The
Can't do.
10th, but I can do the 3rd or the 17th.
Want to shoot for the 17th? Is that
Ron,
too
did I
quick?
recall that y'all had a set time that y'all met quarterly? I thought it was a Tuesday.
Yes, it was.
I think it was either the second or third Tuesday of every quarter of the month.
Want to try for December 8th? The Tuesday?
That's fine.
December
10
8th,
o'clock, Ron, 10 o'clock, is that what we're talking about still? 10 a.m.
10 o'clock works if that's okay with everybody.
That's fine.
Okay.
So the next meeting will be December 8th, a Tuesday at 10 in the morning. And
Then
I
you-
want to just tell Ron, that, maybe you've just been with the longest meeting here I think we've had at 2 hours and 4 minutes so far. Congratulations.
I feel it's my fault, and Mike's gonna come back and straighten up the ship in
I was
December.
gonna joke and say, when's Mike coming back?
Yeah, I know.
No, I like it. You explain things very well. You're good at it. I can follow it. Well, Mike's good too. With that, I better adjourn the meeting.
Thank you, everybody.
I'll adjourn the meeting at 12:05 on whatever day, Thursday, September 17th.
Thank you.
I
Thank you.